Yeah, you've been given now in this case the income statement and of course the statement of financial position as indicated there. Then in the additional information, so you have a number of informations in the additional information there. There are a number of informations in the additional information there. So the first one there is HEMA Limited acquired the investments in other companies as follows. So of course the companies that it acquired, it is actually Shuka Limited. So that is 1st of May 2014, and of course Ajabu Limited 1st of May 2015. So these subsidiaries were acquired long time ago. They were acquired a long time ago. So of course now in this case, our financial year, you can be able to see our financial year actually is running from 1st of April. So it's actually running from 1st of April 2016 to, in this case, 30th of April. So 30th of April is 1st of May, sorry, 1st of May 2016 up to 30th of April 2017. And of course, now in this case, you can be able to see, you are being told when the subsidiaries were actually acquired. So of course, there's in Shuka, there's a shareholding of 80%. So that is, of course, what it is actually a subsidiary. But the other one is actually 40%. So that means for the other one, Ajabu, it is an associate. For the other one, Ajabu, it is an associate, but not actually what? A subsidiary. So in this case, if you look at now, in this case, our structure, so the structure, so the group structure, if in this case, we are looking at the group structure now, the group structure. So the group structure, so this is our financial year. So they were not acquired in the middle. Remember the other question we did, the subsidiary was acquired 6 months had already elapsed during the financial year under review. But now in this case, it means that for these ones, they were acquired before. So the group structure here will likely be able to indicate HEMA having to be the holding company. And of course, it has acquired 80% of Shuka, 80% of Shuka. And of course, in this case, 40% of Ajabu. 40% of Ajabu. So that is the group structure. And of course, in this case, as per the question, you are being told that this Shuka Limited was acquired on 1st of May 2014. So that means it has actually been in existence for a period of 3 years. Then Ajabu Limited was actually acquired on 1st of May 2015. So it has already been in existence for a period of how many years? 2 years. So none of them was actually acquired in between the year. And therefore, in this case, we are having to consolidate the subsidiary and we are having to account for the associate for the entire year. So there won't be that aspect of allocating even what the income statement items for the subsidiary. We'll be considering for the entire year. So you are told that so the cost of purchase for Shuka Limited was actually 300 million. Then of course for Ajabu it was 200 million. So of course this is now what we call the purchase consideration. So of course you can be able to see the purchase consideration will just been given directly. Remember in our previous one, we were doing share exchange to be able to know what the purchase consideration. But for in this case, you've just been given the cost of investment directly. So they haven't gone into having to indicate, for example, it was through a share exchange, that the holding company exchanged shares to acquire this other one. So they have told us in this case, this is how much was actually paid in terms of cost of investment to acquire 80% control and of course 40% control in the associates. So that is what you're having to be given there. Then, so revaluation reserve, at that particular point in time they acquired, there was a revaluation reserve of 20 and of course 25 in both of them. So remember in this case, we said, if there is any revaluation reserve at the point of having to purchase, the subsidiary, if there's actually any revaluation reserve, you'll have to consider it whenever in this case, we'll likely be coming up with with the goodwill. Whereby in this case, we look at the pre-acquisition. The pre-acquisition in this case, revaluation reserve, the pre-acquisition revaluation reserve, at that point in time they're having to acquire it, you have to consider it when you are computing the goodwill. Then in this case, the retained profits at that particular point in time. So this means this is actually what you're calling what the pre-acquisition profits. The pre-acquisition profits. And of course, you remember our formula for goodwill. Purchase consideration less the net assets. Under the net assets, we are looking at the equity items in the subsidiary or in the associates. So, and in this case, the equity items, we are having maybe ordinary share capital or any other item of equity. Then in this case, we can be able to consider pre-acquisition revaluation reserves and pre-acquisition profits. Remember, for profits and of course the revaluation reserves, you are considering pre. But of course now in this case, for the other item, ordinary share capital, we are taking it the way it is in the statement of financial position. But for the revaluation reserve, we take pre. So in this case, retained earnings, we have to compute and get what was the pre-acquisition profits. The profits that were actually there before they acquired. That is what we consider in having to come up with with the goodwill. So that is why in this case, you'll likely end up having to deal with those items. And of course, you're going to compute the goodwill. So still just under the same note, you're having to be told, HEMA Limited also invested in half of 10% loan stock in Shuka Limited. So if you look at, in this case, Shuka Limited, if you look at, in this case, the statement of financial position for Shuka Limited, just go up there, you'll be able to see a 10% loan stock. 10% loan stock. So the 10% loan stock for Shuka Limited is actually how much? An amount of 200 million. So HEMA Limited also invested in half. At that point in time they were acquiring, they invested in half. So that half of this loan stock is how much? So half of the loan stock. So half of the loan stock is actually how much? So they actually invested in this loan stock an amount of 100 million. 100 million. In short, they paid what? Shuka. They paid Shuka how much? 100 million. 100 million. And of course, if that is the case, if there was money moving from this subsidiary to this other subsidiary, that is what? An intercompany balance. And in this case, we must actually be able to do what? Eliminate. Money moving from here, coming here. Or balances moving from this side. So that's what an intercompany balance. And in this case, we must actually end up having to do what? To eliminate. So it means if this was the money that was actually paid to this Shuka Limited, it means that in this case, that was actually what? An investment. So of course, it was actually an investment by HEMA. It was an investment by HEMA. It was an investment by HEMA of an amount of what? How much? 100 million. So we'll have to eliminate this intercompany balance. So of course, in this case, we'll have to less from investments. We'll have to less this 100 million from investments. Still the same case, we'll have to less from the loan stock. We'll have to less from the loan stock. Ideally, in this case, we would actually end up having to say that we will end up having to, maybe in this case, if this is the case, we'll likely end up having to remove this amount from the investments, and of course now in this case also from the loan stock, so that we can be able to eliminate this balance. Remember, any intercompany balance we have to do what? To eliminate. Any intercompany balance you have to eliminate. So this was actually an investment by the holding company into the subsidiary, an amount worth how much? 100. So of course, to the holding company HEMA, they were investing in the loan stock to get interest. So this loan stock was belonging to Shuka. So for the Shuka, we'll have to eliminate 100. For the investments, for in this case, what? HEMA will have to eliminate how much? 100. And of course, still on the same loan stock, they're having to get an interest. They're gaining an interest. These guys are getting an interest. HEMA Limited, remember, when you make an investment, you get an interest. So the interest for that case is actually 10% of the invested 100 of 100. In this case, you'll get what? 10 million as the interest. 10 million as the interest. And of course, in this case, this 10 million is having to be paid by Shuka to HEMA. That is what? An intercompany balance. So we have to do what? To eliminate. We have to eliminate it. So, and of course, now in this case, we'll end up having to less this from what? From interest, which now in this case will likely be represented as what? So we less from interest. We less this one from interest, which now in this case, this is the finance cost. So interest is the finance cost. Still the same case, we'll have, because this was an income to this one, we less it also from that income, less from investment income. Investment income. We'll end up having to eliminate this one and we eliminate this one because they were intercompany balances. So this one is 10 million. So we'll eliminate those ones. We'll eliminate those. So remember, in this case, when you'll be coming up with the statement of financial position, we'll be lessing this one from the item or the element of investments in our statement of financial position. We'll be lessing this 100 million from the loan stock, In this case, when you'll be coming up in this case with the profit and loss account, consolidated profit and loss account, we'll be lessing this 10 from the finance costs. We'll be lessing this 10 from the investment income because it is what? It is an intercompany balance. Money having to be paid by the subsidiary to this one. Money having to be paid by HEMA to this one. So this 100 was actually paid to this one. This 10 million was actually paid by these two, this. So it is an intercompany balance that will likely end up having to do what? To eliminate. That is what you have to be able to do what? To remember. You have to remember. Then in this case, so we're having to be told the fair value of the non-controlling interest of Shuka Limited was 75 million on 1st of May 2014. So I told you in this case, when you hear about them talking about fair value of the non-controlling interest, they want you in this case to use what? The full what? Full method to determine what? The goodwill. Ukishaona tu wameanza kuongelea fair value of the non-controlling interest, or they have given you the fair value of the non-controlling interest goodwill. That is the full method. They want you to use the full method in terms of what? Coming up with what? With the goodwill or the value of the goodwill. The value of the goodwill. The value of the goodwill. And therefore, in this case, we can try to determine the value of this goodwill. So we've been told that in this case, the fair value of the non-controlling interest in Shuka Limited was 75 million as of 1st of May 2014. So that is the subsidiaries. That was the fair value of the non-controlling interest when they were having to acquire it. Remember, they acquired it on 1st of May 2014. So the fair value at that particular point in time of the non-controlling interest, which is actually 20%. The non-controlling interest is actually 20%. Was actually how much? 75 million. And therefore, in this case, we can be able to determine what? Our goodwill. We can actually be able to determine our goodwill. So this one can be our working one. So in this case, for our working two, let's now in this case see how you will be able to determine the goodwill. So determination of the goodwill. Determination of the goodwill. And therefore, in this case, the usual formula we're having to use here. So we have for two companies, we have Shuka. Shuka is one of our companies. Then we have in this case Ajabu. We have Ajabu. So remember, our figures are in millions. Our figures are in millions. So they are in shillings of millions. They are not actually cows. They are not actually cows. They are actually shillings of millions. So purchase consideration. Purchase consideration. So purchase consideration, we've actually been given in note number 1. The money they paid, which I've already been able to explain there. So it is in note number 1. So this one was 300. They paid 300. They paid how much? 300. So let's try to organize. Let us be a bit organized. 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 So the purchase consideration was actually 300 for this one. And of course, now in this case for Ajabu, it was actually an amount of 200 million. Then in this case, remember this case we said when you are using the full method, on this purchase consideration, you normally add what? The fair value of the non-controlling interest. The fair value of the non-controlling interest, which is actually 75, which you've actually been given 75 million. Then in this case, you less, for this one, there's none. Then in this case, you less the net assets. You less the net assets. You less the net assets. And of course, in this case, the net assets is the capital components of the subsidiary. And of course, what in this case, the associate. So this one, in this case, you have to go to the statement of financial position. Ukienda hapo, in this case, hapo kwa equity and liabilities. Hapo kwa equity and liabilities. In this case, you have ordinary share capital. And of course, you have what? Share premium. So in this case ukiangalia huku kwa shuka hapo kwa ordinary share capital na kwa share premium unaona a value of 250. There are two values there. So in this case we have ordinary share capital. Ordinary share capital, there's a value of, in this case, 200. And of course, now in this case, you have also share premium. Share premium, there's a value of, in this case, 50. For in this case, for the associate, you can see a value of 200, and of course, also 50 is just the same. 200, and of course, also 50. But now in this case, for the revaluation reserves and actually retained profits, tunachukua nini? Pre. Actually, don't forget. For the revaluation reserve, in this case, you're not actually taking them as they are there in the statement of financial position. When you are computing goodwill, for these ones, you take pre-acquisition. The pre-acquisition profits, the profits they acquired, that were there before they acquired. The profits that were actually there before they did what? They acquired. And the results that were actually there before they did what? They acquired. And of course, these ones you've actually been given in note number 1, whereby you can be able to see Shuka, they're having to tell us on 1st of May, the revaluation reserve value was actually how much? 20. And of course, in this case, for this other one was actually how much? 25. Those are what? The pre-acquisition reserves. So pre-acquisition reserves. Pre-acquisition reserves. Pre-acquisition reserves, in this case, as per note number 1, the ones that were there before, at that point in time, they were acquiring. So for this one is actually 20. And for this other one is actually 25. Exactly 25. Exactly 25. Then in this case, we have pre-acquisition profit, pre-acquisition retained earnings. Pre-acquisition retained earnings. Pre-acquisition retained earnings. So also you have been given there under note number 1. Unaona your retained earnings ukomisho 80 and 150. So you have 80. Then of course 150. 150. So if you add them, so these ones, they are under note number 1. These ones, they are under note number 1. You can be able to see them. So you can add, if you add those ones, in this case, this one you should be able to get, that is coming to 350. So this one you less the net assets. 350, you'll be able to get a figure of 25. Then in this case, these ones, when you add, you'll get a figure of 425. You'll get a figure of 425. So 425. But now in this case, remember for this Ajabu, so this holding company is only able to, in this case, control how much? 40%. Is only able to control 40%. So 40%. For this one, we haven't been given we haven't actually in this case been given the fair value of the non-controlling interest. So simply because they're controlling 40%, then in this case, if you get 40% of this one, you'll end up having to get how much? 170. So if you get a difference there, it will likely come to a value of 30. It will come to a value of 30. So for this Shuka, since you've been given this fair value, then we use the full method. But for this other one, we haven't actually been given. So now in this case, you can be able to apply what the partial. Then now in this case, you'll be able to get a value of goodwill for the associate. This one is the associate. So this one is the associate. This one is the subsidiary. This one is the subsidiary. This one is the subsidiary. So this one will likely come to 170, then you minus, you get 30. So for this one, you'll apply full method because you have actually been given what the fair value of the non-controlling interest. For this other one, you can be able to apply what the partial, because in this case, you haven't been given what the fair value of the non-controlling interest. And of course, that is why in this case, you'll likely end up having to get what the goodwill. So the goodwill for the two companies. The goodwill for the two companies. The goodwill for the two companies. Then so during the year ended 30th of April, so Hema sold so Hema Limited sold some goods to Shuka Limited and Ajabu Limited as follows. So as follows. So Shuka Limited, they sold goods in this case worth 100 million. So there was a markup of 25. There was actually a markup of 25. A markup of 25. the percentage of goods still held in stock is actually 50. Is actually 50. So the percentage of goods that are actually still held in stock is actually how much? 50 is actually 50. 50%. So 50% of this. So you have in this case what? The intergroup sales. So the intergroup sales or the intercompany sales. So the intercompany sales. So that one can actually end up having to be our working three. So we have the intercompany sales. Intercompany sales. And of course, in this case, we have from Hema to Shuka. So we have from Hema to Shuka. So they sold goods of a value of 100 million. So goods of a value of 100 million. And therefore, in this case, we said for any intercompany sale or intercompany balances, we end up having to eliminate. So it means these 100 million, we likely less it from the sales revenue. Still the same case, we will less it from the cost of sales, to eliminate it. Just the same way we've been able to do here. You can see here. So the intercompany balances, we eliminate them. So we less from the sales revenue, we less from the cost of sale, because it was a cost of sale. It was a cost of sale for Shuka. It was a sale for Hema. So we'll eliminate it. But remember, there's something having to be told about these goods. 50% of the goods are actually still held. They're actually still having to be held in stock. They're still having to be held in stock. So that means there is unrealized profits on this closing stock that we must actually be able to determine. Remember, I told you, whenever in this case you hear about these goods that were sold, they are still in stock, examine automatically. And amekupea hapo markup ama margin. Anataka in this case utafute what? URP. He wants you to look for the URP or unrealized profit, unrealized profits. And of course, you said if you have actually been given the markup, you convert it into into a margin. Kama amekupea margin ni sawa, uta-convert. But in this case, amekupea nini? Markup. So in this case, it means you'll take 25% over 100 plus 25. So it becomes 125. So the URP, the unrealized profits. Then you multiply by, in this case, the sales, which was actually 100. But remember, out of these sales, only 50% is actually still in stock. So we have to apportion that percentage. So it is actually 50% is actually still in stock. So if you do the computation there, you'll be able to get 10 million as the unrealized profits. You'll get 10 million as the unrealized profits. In this case, how do you treat unrealized profits? You'll end up having to add it, because it was a profit which was not actually realized. So you'll add it on the cost of sales. Then you less from the closing stock. So this is how you basically deal with these 10. So remember, we'll be coming up in this case with our income statements. On the cost of sales, we'll have to add this amount. Then of course, now in this case, we'll be coming up with our balance sheet. On the closing stock that we'll recognize in the balance sheet or statement of financial position, we'll have to less this 10. So you need to be able to take note. As you are doing your workings, inafaa ujue zinaenda wapi. Usiku unafanya workings zenye ujui penye utazipeleka. Sasa unazifanya za nini? You need to know, where will I take them? For example, if it is the intercompany sales, I less them from the sales revenue. I less them from what? From the cost of sales. If it is unrealized profits, I'll add it back on the cost of sales. I less it from the closing stock. Usiku unazifanya hapa na ujui utazipeleka wapi. So you need to know where you'll be able to take them. If it is goodwill, then I'll be able to consider it when I'll be coming up with what? The consolidated statement of what? Of financial position. Consolidated statement of financial position. So that, of course, that is why in this case, you likely end up having to deal with what? The intercompany sale. Remember, the ones for Ajabu, we won't consider them, because in this case for Ajabu, we are not actually having to consolidate it. Remember, in this case, I told you, for associates, we use the equity method. The equity method to do what? To consolidate. Sasa tukienda kutengeneza huko sasa, unaona sasa tukienda kutengeneza huko sasa the consolidated income statement, tutakuwa tuna add tu za Hema na Ajabu. Tutakuwa tuna add tu za Hema na Ajabu. Hizi za hii hatutakuwa tuna add. Because now in this case, we don't actually consolidate in this case what? The associate. we don't actually consolidate what the associates. So we won't actually consider these intercompany sales that were there within this case what Ajabu. Those ones are non-issue. They are non-issue because you're not consolidating it. We are using the equity method. The equity method. And of course, in this case, we'll be able to see when we'll be coming up with the income statement, associates pale kwa profit after tax ndio inaanza kuonekana. Haitaonekana mahali popote mpaka hapo ndio sasa itaanza kuonekana sasa. And then in this case, in the statement of financial position, there's an item I told you we'll be able to compute investment in associate. So it means that in this case, also for the statement of financial position, tutakuwa tunaangalia tu mambo ya, in this case, Hema and Shuka. To calculate to investment in associate, which now in this case, you're going to calculate. So that is the figure you'll be able to take into the non-current assets of the consolidated financial statements. The point you are trying to drive home, for associates, you don't actually consolidate, you use the equity method. Use the equity method to do what? To, in this case, combine with the consolidated what? Financial statements. Then the next note, on 1st of May 2016, Hema Limited sold to Shuka an item of plant and equipment of 200 million, reporting 25% profit on cost of the plant. The group charges a depreciation of 20% per annum on cost, So that was actually an intergroup sale of what? Fixed asset. So an intergroup sale of fixed assets. An intergroup sale of fixed assets. So in this case, it was from so on 1st of May 2016, Hema sold to Shuka Limited an item. So Hema is the one that was actually selling. So Hema to Shuka. An item of plant worth 200. An item of plant worth 200. So so for this particular item, in this case, it was actually sold at a profit. It was actually sold at a profit. And therefore, in this case, we'll likely end up having to calculate what the unrealized profit. So on 1st of May 2016, Hema Limited sold to Shuka an item of plant of 200, reporting 25% profit on cost of the plant. The group charges depreciation at 20% per annum on cost of the plant. On cost of what? Of the plant. So the intergroup sale of the fixed asset here, so we'll determine what was actually the profit. What was actually the profit here. So of course, now in this case, it was a markup, so we'll convert it into what? Into a margin. So over 125, you multiply by, in this case, the amount of the sales. So in this case, we'll get what we call what? 40. So we'll get actually 40. So 40, an amount of 40, which now in this case, we'll end up having to add. So we'll end up having, in this case, do what? Add on the cost of sales. So we'll add on the cost of sales. We'll likely add on the cost of sales. Then in this case, we'll end up having to credit the property, plant, and equipment. We'll less it from the property, plant, and equipment. Then there was an overcharge of depreciation. So there was an overcharge of depreciation. There was an overcharge of depreciation on this particular what? Profit. On this particular what? Profit. So we are told that in this case, they charge 20% per annum on cost of the plant. So the overcharge of the depreciation, in this case, will likely be 20%, 20% multiplied by this amount of 40. So you likely get how much? 8. So for these 8, the overcharge of the depreciation here, we likely end up having to debit the plant and the equipment. And of course, now in this case, we credit the cost of sales. 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 So remember, in this case, also, this was actually what? An exchange of an asset. It was actually like an exchange of the asset from, in this case, what? Hema Limited to Shuka. From Hema Limited to Shuka. From Hema Limited to Shuka. So therefore, in this case, on this exchange of an asset, they ended up having to sell it at what? At a profit. At a profit. So we'll have to end up having to do what? To eliminate this kind of what? A profit by having to do what? we'll debit the cost of sales, or we'll add on the cost of sales, then we credit what? The property, plant, and equipment. But on this particular sale of the assets, because they are having to sell it at a profit, then it means that there was actually an overcharge of what? Of depreciation on the sale of these assets. So therefore, in this case, we'll take 20% of that unrealized on that particular profits on the sale of the asset, which now in this case will likely be 8. Will likely be 8. So this particular 80 here, because it was an overcharge, it was actually an overcharge. It means that in this case, it was reducing the value of the property, plant, and equipment. And therefore, we'll have to add it back on the property, plant, and equipment. But of course, now in this case, we do what? We credit the cost of sales. We credit the cost of sales. So that's why in this case, you'll end up having to deal with what? The intergroup sale of the fixed asset. The intergroup sale of the fixed asset. The intergroup sale of what? Of the fixed asset. Then, so number five, all the goodwill of the two companies in which HEMA Limited has invested are estimated to be impaired by 60% to the year ended 30th of April. 20% of the impairment relates to the current year. 20% of the impairment relates to the current year. So we can now, in this case, look at the impairment of the goodwill. So impairment of the goodwill. Impairment of goodwill simply means loss of value. Impairment of is like a depreciation. Impairment of the goodwill. Impairment of the goodwill. Impairment of the goodwill. And therefore, in this case, impairment, we are having to be told that in this case, it is all the goodwill of the two companies in which HEMA Limited has invested are estimated to be impaired by 60% to the year ended 30th of April 2017. So in this case, this goodwill that we've actually been able to compute here, 25 and of course 30. So for all the companies they have invested in, it doesn't matter whether it is a subsidiary or an associate, up to, in this case, the end of this particular year, 30th of April 2017, it means the goodwill has actually been impaired by 60%. So the impairment of the goodwill here will likely be 60%. You multiply by 9. In this case, the two goodwills, 25 plus, which is plus 30. So 60%. Up to the end of this year, it is 60% impaired. So that means you'll likely end up having to get a value of 33. Exactly 33. But remember, we've actually been told that 20% of this impairment actually relates to what? To the current year. And of course, the year we are looking at in terms of consolidating the financial statements, it is the current year. So that is what you are coming up with. So for us to know what we'll be able to take into the P&L account as the goodwill, as the impairment of the goodwill, we'll take 20% of this total goodwill. Total impairment, 20% of this total impairment to take it to the current year. So remember, since they started, they actually acquired these subsidiaries. The impairment in total, kutoka hizi mwaka zianze, so hapa, wamesema hapa in total. So this one had already existed for 3 years. This one is for 2 years. So for the 3 years plus 2, this total goodwill here has been impaired by a value of 60. So 60 of this is 33, but 20% of the total impairment relates to the current year. So we'll take 20% of this, which now in this case will likely be 6.6. It means this is what will likely be able to take into the P&L account, as in this case, what our goodwill for the current year, our P&L account as for the goodwill in the current in the current year, as in the P&L account as the goodwill, impairment on the goodwill in the current year. Then trade receivables and trade payables included 50 million due from Shuka Limited to HEMA Limited and shillings 10 million due from Ajab Limited to HEMA Limited. So this is still what you call an intercompany balance. But in this case, we have to be able to do what? To eliminate. So in this case, our working number 6. So in this case, the intercompany balance of 50 will end up having to eliminate it. So the intercompany balance, there's an intercompany balance of how much? 50. It is an intercompany balance because now in this case, you can be able to see what you're having to be told here. So trade receivables and trade payables included 50 million due from Shuka Limited to Hema Limited. That in this case, in totality, the trade payables and trade receivables actually include an amount, in this case, that is actually 50 million due from Shuka. So this Shuka owes this Hema Limited an amount of 50 million. So inamaanisha kwamba huyu Shuka anafaa kumlipa huyu. So there's an exchange of this money between the company. So exactly what an intercompany balance that we must actually be able to do what, end up having to do what, to eliminate. So it means we'll be able to eliminate, we'll eliminate from the trade receivables and the trade payables. Remember, in our previous question, there was cash in transit, but hapa sasa hakuna. You remember what I was trying to explain yesterday, that if there's a cash in transit, then in this case, it simply means we'll be able to only consider having to deduct from the trade receivables. We won't deduct from the trade payables because the payable alikuwa shalipa. But in this case, in our situation here, ajalipa. So it means in both scenarios, under the current assets, we'll deduct from the trade receivables. Under the trade payables, we'll deduct from what? From the trade payables. But if it happened that in this case, already Hema alikuwa amelipa, or in this case, Shuka was the payable. Was the one who was supposed to pay. Shuka alikuwa shalipa, but the cash was actually in transit. Remember what we said. If that is the case, you eliminate from trade receivables, but you consider this cash in transit as part of the current assets. But in our situation here, we haven't been told there's money which has actually been paid that is still in transit. So it means there's no cash in transit. We won't consider this cash in transit in our statement of financial position like we did yesterday. So it means in our situation here, we'll end up having to deduct both on the trade receivables and on the trade payables. But if there was a cash in transit, it means that in this case, we wouldn't have deducted from the trade payables. We would have deducted from the trade receivables. Then, of course, we consider this 50 as a cash in transit as part of the current assets under what? The balance sheet. So that is what you need to be able to note as a difference with what we had yesterday. So, and of course, I still explained it yesterday. So I think you can be able to get now the difference. So they can tell you a situation whereby maybe they had already paid, but they haven't received the money. It is still in transit. That is what we call what? Cash in transit. So that's how you deal with that one. So 10 million due from Ajabu. So of course, in this case, we're having to say that matters regarding Ajabu, we are using the equity method. So we won't consider it in terms of what having to eliminate the intercompany balances. We don't consolidate it. So we won't be able to consider that one. All dividends and interest had been paid by the end of the year. So all dividends and actually interest had actually been paid by the end of the year. So of course, now in this case, for the dividends, we'll actually end up having to do what? We'll end up having to eliminate it. When in this case, we'll likely be coming up now in this case with the income statement or the P&L account, we'll likely end up having to do what? To eliminate it, to eliminate this amount. So of course, now in this case, we can start maybe preparing our income statement. So the consolidated income statement, we can start preparing the consolidated income statement, the consolidated income statement. So you have in this case, we have in this case, HEMA group. So you have HEMA group, consolidated income statement. HEMA group consolidated income statements for the year ended. So 35 of it is 31st of 30th of April. It is 30th of April. 30th April 2017. 30th of April 2017. 30th of April 2017. So of course, in this case, we can be able to start with the revenue. So we can start with the revenue. So our shillings are actually in million. 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 So someone is telling me we compute first of all the investment in associates. So no problem. We'll be able to compute it. We'll be able to compute it. Let's, in this case, first of all, look at what this particular so the consolidated income statement. So we'll be able to compute it. So revenue. So we have in this case revenue. So of course, for revenue here, we'll be able to take the one for the holding company and the subsidiary. Remember, in this case, I've told you for the associate, we don't actually, in this case, do what? Consolidate the associate here. We don't actually consolidate the associate here. So we just, in this case, do what? Consolidate what is actually in the holding company and, of course, what? The subsidiary. And, of course, remember for our situation yesterday, the subsidiary was acquired in between the year. So we were having to reapportion what? The items in the income statement. But now in this case, for this case, it was actually owned for the entire year. It was actually owned for the entire year. So in this case, for the revenue, we'll be able to add 1,200 plus, now in this case, 600. Then there was an intercompany sale. You remember it, 100, which I told you less. Hope you can be able to remember it. So 100, it is in the working. It is actually in the working. You'll end up having to less it because you'll be able to get an amount of 1,700 million. And in this case, you have the cost of sales. So for the cost of sales here, we'll take for the holding company, which is actually 650. We add that one for the subsidiary, which is actually 250. Remember, this one we are not apportioning because it was owned for the entire year. And of course, for the associate, we are not adding because we don't consolidate associates. We use the equity method. But remember, for this one, there was an amount of, in this case, what? There was this one, intercompany sale. This one, we have to eliminate it, 100. Remember the intercompany sale where I told you less from the revenue and, of course, you less from the cost of sales. It was 100. Then, of course, there's another item of, in this case, depreciation overcharge, an amount of 8 shillings on the sale of the fixed asset. Then, of course, now in this case, also we have what? There was a disposal gain, the profit on the sale of this asset. You add it. Then, of course, in this case, also you add what? The unrealized profit. You add the unrealized profit. You add, in this case, what? The unrealized profits over 10. I think it was 10. It was an amount of 10. So you'll have to adjust with all these items. So you can see in this case, the intercompany sale, depreciation overcharge, then the profit on the sale of the fixed assets. Then, of course, now in this case, what? The unrealized profits on the closing stock. I think there's unrealized profits on the closing stock. The unrealized profit on the closing stock was an amount of, I think 10. It was an amount of 10. It was an amount of 10. It was an amount of 10, which is said in this case, you'll add on what? On the cost of sales. So it was an amount of 10. So if you end up having to add those ones, I think you'll be able to get an amount of 842. So take note of these adjustments. So remember in the workings, I was telling you, you need to take note where you'll be taking them. So these ones, we had actually computed them in our working. So you'll be able to get, in this case, a figure of 842 858. Then you have in this case investment income. Investment income. So for the investment income here, remember there was interest on what? On loan. So there was that loan that HEMA acquired paid in what? I think 10% loan stock. They invested in HEMA. And of course, they were having to be paid what? Interest. And of course, you say this what is actually an intercompany balance that we must actually be able to end up having to do what? To eliminate. It is an intercompany balance that we must actually end up having to do what? To eliminate. Then in this case, if you look at now in this case, the income statement, if you look at the income statement for these companies, we have in this case, Shuka, you can see there was a dividend that was actually paid of 50. And of course, now in this case for Ajabu, there was a dividend that was actually paid of 30. And of course, now in this case, it means if Shuka and Ajabu are having to pay, in this case, HEMA dividends, there's money moving. Remember, in this case, there's money moving from this subsidiary to this other company. And that is what as an intercompany balance. You have to eliminate it. And therefore, in this case, we'll end up having to less from what? From the investment income. So of course, now in this case, I don't know whether you'll be able to put it as a working. So there's investment income. So the investment income for, of course, the holding company, as per in this case, what the income statement you've actually been given is an amount of 70. But you are saying in this case, you'll end up having to less that interest. There's that interest, loan interest, we computed in working one. It is an intercompany balance that you must actually be able to eliminate, which is actually 10. But of course, now in this case, also there was dividends that was actually paid by the subsidiary and associates to the holding company. And of course, in this case, they are controlling how much? 80% and 40%. So it means of these dividends, 80% ilikuwa inaenda kwa hawa HEMA. 40% ya associate ilikuwa inaenda kwa hawa HEMA. That is an intercompany balance which will actually end up also having to do what? To eliminate there. And therefore, in this case, you'll likely less also in this case 80% of 50 plus in this case 40% of, in this case, that dividends for the associate is actually 30. Ukiangalia income statement utaziona hizo. So we eliminate them. And of course, in this case, you'll be able to get the amount of the investment income there. You'll get a figure of, I think, 8. Exactly 8. So that is what the investment income. That is the investment. If you compute this one, you should be able to get, I think, 8. So that is, I think, okay. It is okay. Then in this case, we can actually be able to do what? Consider the expenses. So that is investment income. So 70. So remember the one, you can see in this case in Ajabu there is 1, but we're having to say that we don't consolidate what? In this case, an associate, we don't consolidate it. So that won't actually end up having to matter for us, So then in this case, you have what? Distribution cost. So distribution cost now in this case is actually 100 plus 40. 100 plus 40. Hiyo hatujafanya adjustment yoyote, so itabaki tu hivyo. This one you are lessing. Then now in this case we have what? Admin expenses. So for the admin expenses here is actually 130 plus, in this case, 90. So this one we are not having to adjust it in any way. So 220. Then you have in this case finance costs. Finance cost in this case we have 40 plus 20. But remember, kuna kale ka item ka loan aka Kenya tumeadjust hapa aka. Tulisema tulikuwa tunasema tuna eliminate from the interest, and the interest of course is the finance cost. So eliminate the intercompany balances. So utailess huko kwa invest kwa sababu in the holding company walikuwa na receive kama income. So you remove it. Then of course, now in this case, it was a finance cost. It was here. Ilikuwa hapa. So lazima tuitoe. So we eliminate it. We eliminate the intercompany balance. And that in this case, we'll end up having to get a finance cost of 50. Then in this case, we have impairment on goodwill. Impairment on goodwill. So the impairment on goodwill, which we've already been able to compute, tulikuwa tumeifanya mahali, ilikuwa I think working, there was a working, which in this case we got an amount of 6.6. There was an impairment on goodwill of 6.6. So, and therefore in this case, we'll be able to get profit before tax. So the profit before tax, in this case, you should be able to get a figure of 449.4. And therefore in this case, we have what? The tax expense. The tax expense. So for the tax expense here, so we'll also end up having to add for the holding company and of course for the subsidiary. So that one will just end up having to add it direct. So tax expense is actually 70 and 50. You'll get 120. So of course for the tax expense, you also less. Then in this case, we get what? Profit after tax. So profit after tax, the profit after tax, which now in this case is an amount of 329.4. 329.4. Then so this is where now in this case now the associate comes in. So if you look at now in this case the income statement of the associate, the income statement for the associate, you can be able to see profit for the year is actually 70. Hope you are there. Hope you are there in the question. You can be able to see now in this case in the profit for the year. So after profit after tax hapo, kuna profit before tax ambayo ni 101, then kuna income tax ya 31, then in this case kuna profit after tax ya 70. So sasa hapo ndio sasa associate inaingilia. So unaona hizi zingine zote tumekuwa tukishughulikia mambo tu ya holding company na subsidiary. Sasa in this case associate hatukuwa tunaiongelelea. Sasa hapa ndio tunaanza kuiongelelea. These are basically now in this case you do what? You put together what? The associate together with what? With the holding company books of accounts. So we just be able to take what? 40% of this what? Profit after tax. And therefore in this case, add the associate share of profit after tax. So add the associate share of profit after tax, which now in this case will likely be 40%. You multiply by, so because they are controlling 40% of the associates, want to control 40% as per our question. So the 40% of this 70, you'll actually be able to get an amount of 28. So you'll add it. These are profits they're enjoying. They are controlling 40% of the shareholding in the associate. So therefore, if they make any profit, they are controlling 40% of that profit. And therefore, in this case, you'll get an amount of 357.4. So 357.4. So that will be the total profit. Total profit. 357.4. So 357.4 is the total profits. So you can see where now in this case the associate actually comes in. So inakujia tu hapa. So huku kwengine hatuiongelelima. We don't consolidate. We just take what? The profit after tax, the holding company portion of the profit after tax. Then in this case, we combine with the profit of what? Of the holding company, or the profit of the entire group. Profit of the entire group. So you need to be able to take note of that. But in this case, that's when in this case, the associate inaingililia hapo sasa. The associate inaingililia hapo. The associate inaingililia hapo. Inaingililia hapo. So we can now in this case start looking at how you likely end up having to come up with what? With now in this case, what? The statement of financial position. But in this case, there was someone who was actually mentioning about what? Investment in associates. So because in this case, the investment in associates is one of the items we'll likely be able to consider when you likely be coming up with what? The statement of financial position. So remember in this case, we said we don't consolidate associates. So now the item of the associate ambayo sasa consider when we are coming up now in this case with the statement of financial, we need to compute what? With the investment in associate. And of course, I remember yesterday, I think I was actually able to give you like a format as far in this case, we end up having to come up with this. We end up having to come up with this. We end up having to come up with this. We end up having to come up with this. So investment in associates. I don't know, it will be working what? So maybe in this case, maybe you can be able to call it, is it, I don't know, as per your workings, is it working, I don't know, it is 8, maybe it could be 8 or something. So investment in associates. Before we come up with the balance sheet, investment in associates. Investment in assets. And as per our formula, you remember yesterday, I think it was the last thing we learned about. I told you in this case, you take the purchase consideration. You take the purchase consideration. Purchase consideration, which in this case, it is as per note number 1. Yani walilipa pesa ngapi kununua hii associate. Walilipa pesa ngapi kununua hii associate. And of course, in this case, as per note number 1, you can see they paid, the cost of purchase was actually 200 million. It was actually 200 million. So it is actually 200 million. Then in this case, we are saying you add post-acquisition changes in net assets. So the post-acquisition and post-acquisition changes in net assets. Changes in net assets. The post-acquisition changes in net assets. And therefore, in this case, the post-acquisition changes in net assets. So you'll end up having to look at, if you look at now in this case, so like now in this case, the retained earnings. So the retained earnings, so the retained earnings now in this case is actually, so we have in this case retained earnings equal to. So the retained earnings at this particular point in time they're having to acquire was actually 150 for the associate, and of course in this case it was like actually an amount of 80 for the subsidiary. It was actually an amount of 80 for the subsidiary. So as at the date of acquisition, it was actually 150. And of course, now in this case, for the revaluation reserve, it was actually an amount of 25, an amount of 25. So and therefore, in this case, if you look at now the income statement, so the income statement for Shuka, I think for Shuka, we have an amount of, so for Shuka, it is actually an amount of 375. And therefore, in this case, we'll actually end up having to take, the post-acquisition changes in net assets, So we have in this case, the retained earnings. Of course, in this case also we have what the revaluation reserve. The revaluation reserves. So as per note number one, we have in this case, as of 1st of May, the retained earnings for Shuka was actually 80. And of course, in this case for Ajabu, it was actually 150. So in this case, we are only considering in this case those ones for Ajab. So because Ajab is the associate, Ajab is the associate. So for the retained earnings, it was actually 150, and of course for the reserves, it was actually 25. Then of course, now in this case, if we look at our statement of financial position, we can be able to see. So the revaluation reserve we have in this case, it is 50 and 200. So 50 and actually 200. So it means in this case, for the retained earnings, we'll take 40, because we are controlling 40%. If you look at now, in this case, the retained earnings in the statement of financial position, that we've actually been given up there, just up there, you can be able to see it. You can actually be able to see it. In this case, we have a retained earnings or retained profit of 200. But at the point of having to acquire, it was actually 150. Then of course, now in this case, for the revaluation reserves, since you are controlling 40%, in this case, in the balance sheet up there, it is actually 50. But now in this case, at the point of acquisition, you can be able to see revaluation reserve was actually 25. 25. 25. So hope you've been able to see how we've gotten these ones. So take note that in this case, these ones, we are getting them from the, in this case, what? So from in this case, the balance sheet that we've actually been given up there. So this is actually what the total retained earnings for this associate. This is the total revaluation reserves for this associate by the end of this year. By the end of this year. But now at the point we are having to acquire them, the retained earnings were 150, and of course the revaluation reserves were 25. And of course, in this case, we want to add what the post-acquisition changes in net assets. The post-acquisition share in changes of what of the net assets, the post. So we have to take in this case what we have currently, we minus what was actually pre, because these ones were pre-acquisition. Remember, we used them in this case under goodwill computation as pre. These ones were before they acquired. These ones are as per the current end of year, as per the current end of year, and therefore the difference will be the changes. You know what I mean by a change? Yani imebadilika kutoka wapi mpaka wapi by the time wali acquire. Imebadilika na 50, imebadilika na 25. So it is post-acquisition changes in net assets. And therefore, in this case, if you do the computation there, you'll be able to get this one as 20, and of course, this one as 10, and of course, the total in this case comes to 230. 230. And therefore, in this case, this is how you compute what the investment in associates. So this is what you'll be able to consider under what the statement of financial position. Under the non-current assets, under the non-current what assets, under the non-current assets. And then in this case, we can actually be able to compute the non-controlling interest, the non-controlling interest, the non-controlling interest, the non-controlling interest. We can be able to compute it, the non-controlling interest. The non-controlling interest, we can actually be able to compute it. So working 9. So the non-controlling interest, non-controlling interest, the non-controlling interest. So in this case, we are looking at the non-controlling interest. That in this case is exactly what in Shuka. Shuka was the subsidiary. So in Shuka, the non-controlling interest is actually 20%. What they are not controlling, non-controlling, they are not controlling 20%. Then we take the items that are under what? Under equity. The items that are actually under equity. So you go now in this case to the what? To the statement of financial position of in this case what? This Shuka. So hapo unaona kuna ordinary share capital ya 200, kuna share premium ya 50, kuna revaluation reserve ya 50, na kuna retained profits ya how much? 375. So you take those items. 200 plus in this case 50 plus 50 plus 375. 375. So you take those items. Hizi unazichukua kutoka hapo kwa balance sheet ya Shuka. Then the non-controlling interest is 20% of these net assets. But of course, now in this case, there was in this case depreciation overcharge on the asset which had actually been acquired. Remember, there was an asset that was actually acquired, and by to compute up on depreciation overcharge, an amount of what? Of 8. So that was an overcharge, which means in this case, it was reducing the retained earnings. It was an overcharge which was actually reducing the retained earnings of what? Of Shuka. And therefore, in this case, we have to do what? We have to add it back so that we can get the correct retained earnings. Ilikuwa ina reduce profit ya Shuka, that depreciation overcharge. If you overcharge depreciation, it means you'll understate your profits. So you'll have to add it back. And therefore, in this case, when you do the computation there, you'll be able to get an amount of 136.6. But of course, now in this case, there was what? Goodwill. We'll have to add goodwill. We'll have to add what? Goodwill. We'll have to add goodwill. And of course, the non-controlling interest goodwill, will likely in this case be how much? So the non-controlling interest goodwill. So you can look at the non-controlling interest goodwill. So the non-controlling interest goodwill will be able to take the fair value of the non-controlling interest. Then in this case, we less the portion of what? We less the portion of, in this case, what? The net assets at acquisition. So the portion of the non-controlling interest net assets at acquisition, which in this case, we'll likely be able to get. So the non-controlling interest goodwill. So non-controlling interest, we can be able to compute it. So you add the non-controlling interest goodwill. And of course, for the non-controlling interest goodwill, we'll be able to take, so the fair value of the net assets at the point of acquisition, which was actually 75 million. Remember, in this case, what we had actually been told as the fair value of the net assets when they were acquiring this subsidiary was actually 75 million. Then in this case, we take the portion, we minus the portion. We minus the portion of what? Of the non-controlling interest in the net assets. In the net assets. So when you talk about, in this case, the fair value, it is like the consideration of this non-controlling interest at the point of what? Of acquisition. At the point of acquisition. And therefore, we must be able to less the portion of the net assets that are going to the non-controlling interest, which is actually 20% at the point of acquisition. And of course, now in this case, this non-controlling interest fair value that we've been given is actually 75 million. But in this case, you have to less the 20%, which is the non-controlling interest in the net assets at the point of acquisition. So that in this case, you can be able to know at that point of acquisition how much was actually what? The goodwill. And that in this case, we'll take 20. Then remember those items we used to compute the goodwill that was actually in this case attributable to the controlling. The goodwill that was actually attributed to the controlling. Remember in this case, we computed it and we got a value of what? Of 25. So we'll be able to take those items. And of course, now in this case, they were totaling to how much? 350. So this equals a total of 350. And therefore, in this case, you'll get a value of non-controlling interest goodwill of how much? 5. Of 5. And non-controlling interest goodwill of how much? 5. Of 5. So there's something I need to be able to explain here. Remember, I told you that in the additional information, when they want you to use the full method to compute the goodwill, they can either give you the non-controlling interest fair value, which you are given as 75. Alternatively, they can end up having to give you this 5. Unakumbuka ile swali yetu ya jana? Swali yetu ya jana walikuwa wametupatia hii. Walikuwa wametupatia hii. Hawakuwa wametupea the fair value. Hawakuwa wametupatia hii. Walikuwa wametupea hii. If you are a very keen student, you can be able to remember. Kama ulikuwa unafuata what was happening in yesterday's class, you can be able to remember. In our yesterday's question, in the additional information, they had given us the fair value of what? Of the goodwill of the non-controlling interest. In our question, they have given us the fair value of non-controlling interest. And therefore, in this case, at that working, kirudi kwa hiyo working ya tumefanya leo, tumesema kwamba purchase consideration, you add the non-controlling interest fair value. But nilikwambia in this case, if they have actually given you this one, if they have given you this one, what you do in this case, you'll end up having to take the purchase consideration, which is actually in this case an amount of much, how much? 300. Then you less the net assets. You less the net assets. Then you take a portion of these net assets, you less from what? From the 300. Then you add this what? 5. You'll be able to get what? The total goodwill of how much? 25. In short, wacha niwafanyie hapa ndio sasa muone. You need to be able to grasp what is actually happening here. So just look at that working been able to do of goodwill. Hii ya leo tu. Hii ya leo tu yenye tumefanya. Hii ya leo tu yenye tumefanya, hebu tu iangalie vile tumeifanya. Hiyo ni full method. Na kwa hii ya leo walikuwa wametupea the fair value of non-controlling interest. Kwa ile swali yetu ya jana walikuwa wametupea the fair value of non-controlling interest goodwill. Walikuwa wametupea sasa 5 in the additional information. So if that is the case, if you are computing now the goodwill, utakuja uifanye hivi. If you are computing the goodwill sasa, utakuja uifanye hivi. Hiyo ni kama examiner amekupea hiyo 5. Hajakupea hii. Hiyo amekunyamazia. Amekunyamazia sana. Amekupea sasa hiyo ingine. So in this case, you will take the purchase consideration. Purchase consideration. We check the purchase consideration, which now in this case is actually an amount of how much? 300. So you won't add directly because this one utakuja pewa, hauta add. Kwa sababu hujapewa. Then in this case, you less what? The net assets. You less what? The net assets. Less the net assets. And of course, hakuna haja tufanye hivyo separate. So total net assets hapo zinakuja how much? 350. 350. But you take what? 80% of this. 80% of this. So if you take 80% of that, I don't know how much you get. In this case, if you compute 80% of this, 80% of that, you get how much? You get how much? 80% of that. 80% of this, how much are you having to get? 80% of 350. How much are you having to get? 280. 280. 280. So this one you are lessing the net assets. Ukiless unapata ngapi? 20, si ndio? Sasa unakumbuka kwa ile swali ya jana tulikuja tukasema kama umepewa hii unaanza tu na purchase consideration, then una less the net assets, but you take 80%, you less from what? From the purchase consideration. Therefore, in this case, at the end, you can be able to remember. If you're a keen student, if you can even go back to your book, you'll see we ended up having to add non-controlling interest goodwill, which now in this case, in our case, is exactly what? 5. So it means the total goodwill is actually 25, which you've just computed when we ended up having to use this method where directly we are adding fair value here. Hope you are getting what I'm trying to drive home. The examiner can give you this figure, or he can give you this figure. So now in this case, the approach here, kuna mali uta add, kama wamekupea fair value of the non-controlling interest, utai add up back before you less the net assets. But the net assets, you don't apportion with 80. You don't apportion with 80. Directly, utazi less to hapo, na utapata nini? Goodwill. But kama amekupea hii non-controlling interest goodwill, then inamaanisha, of course, you'll take purchase consideration, less the net assets, but you are portioned with the control, which is 80%. You less from this one, you get 20, but you add back that one to get what? The total goodwill. You'll get the same value of goodwill. Take note, the examiner can give you the non-controlling interest fair value, or he can give you the non-controlling interest goodwill value, which now in this case, we've been able to compute here. We've gotten how much? 5. So take note that is what in this case, what the difference that you can actually be given. So unaweza compare hizo, now you need to actually to be very keen. So therefore, in this case, our non-controlling interest goodwill, we've already been able to compute it here. So you take in this case the fair value of Shuka, in this case, the fair value of the non-controlling interest. You take 20%, which is the non-controlling interest of the net assets, which is 350. Then in this case, you get the difference, you'll be able to get a goodwill of how much? 5. But remember, we've actually been told that the total goodwill of this entity was actually having to do what? Was actually losing a value. Was actually losing a value of how much? 60%. It has lost a value of 60% since what? Acquisition. So therefore, in this case, we'll end up having to look at what the impairment of this goodwill. Impairment of this goodwill is actually, in this case, 5 multiplied by 60%. Hii goodwill imekuwa impaired tangu wanunue. Of course, this is the total goodwill of the non-controlling interest. But remember, in this case, we are told there's a note there. We've been told that the entire goodwill of the entire group is having to be impaired by 60% since what they acquired. So therefore, in this case, the impairment on this goodwill is actually 60% of this, which is actually how much? 3. So we less 3 from this, we'll end up having to get what? A total goodwill of the non-controlling interest at the point in time we're having to consolidate of an amount of 2. An amount of 2. And therefore, in this case, our total non-controlling interest, in this case, will likely be an amount of 138.6. 138.6. Remember, this one now will likely be part of the items that we'll be able to add in the statement of financial position under what? Equity. Under equity. So now in this case, we can look at the final working. So the final working now in this case is for the retained earnings. So the final working is actually for the retained earnings. So the retained earnings. So retained earnings. So retained earnings that have actually been given here. So of course, now in this case for the holding company, so we have in this case, we'll take for the parent. So the retained earnings for the parent, which is actually in this case 710. But you less from this one, in this case, what? The profit on sale of plant, which will end up having to eliminate profit on sale of plant. Then we less the unrealized profit, which are actually computed of 10, so you'll get an amount of 660. 660, then add investee share of post-acquisition. So add the post-acquisition share in retained profits, post-acquisition share in retained profits, that is in the subsidiary and associates. So the post, not pre. Remember kwa hapa tunaangalia the post. Somebody the group enjoyed profits after they acquired. So in this case, you are looking at what the post-acquisition. So there, in this case, for Shuka, so for Shuka, you've actually been given there, the retained is total exactly 375, but of course they are controlling 80%. It means 375. Then in this case, you less 80, which you've actually been given there under note number 1. So the pre-acquisition was actually 80. It means the post, you get the difference. So you less 80 from that, but there was actually a depreciation overcharge of 8. So you end up having to add it. So you get an amount of 242.4. Then in this case, Ajabu. We have Ajabu. Ajabu, they are controlling 40%. And of course, as per the income statement that you've been given the question, hapo juu to hapo retained profits total yote kwa hii associate imefika saa hii penye tunaongelelea hii 30th of April tunaongelelea iko an amount of 200. But now in this case, we have the pre, which you've actually been given under note number 1. So it is an amount of 150. So if you do the computation there, you should actually be able to get an amount of 20. And therefore, in this case, it comes to 922.4. 922.4. So those are now in this case. This one now in this case is the item you'll be able to consider under equity in the consolidated statement of financial position. Consolidated statement of financial position. And therefore, in this case, we can actually be able to come up with that statement of financial position very quickly. Then I think we can finalize. We can finalize with it. Let's finalize with it. Let's finalize with it. Let's finalize with it. Let's finalize with it. So HEMA group. So HEMA group statement of financial position as at 30th of April. HEMA group statement of financial position as at 30th of April. We have in this case property, plant, and equipment. So you have property, so you have the non-current assets. So you have property, plant, and equipment. So property, plant, and equipment, remember in this case, tumesema, we are consolidating what? The holding company and the subsidiary. So associates are to consolidate. Associates. You have to consolidate. So in this case, we'll be able to take for, in this case, the holding company is 1250. We add now, in this case, how much? 800. So 1250 plus 800. But remember, there was an item of depreciation overcharge, which you have to add back because the equipment less than EPPE further. Then in this case, there was a gain on disposal of 40. So remember what I was telling you in the workings. So if you look at your workings, I had indicated for you. So it is actually 2018. It is actually 2018. Then we have intangible assets. Hizi hazina story mingi. So we'll just add directly. It is 200 plus 70. Hizi hazina mburucha. Mingi. So 270. Then now in this case, we have investments. We have actually what in investments. investments. We have investments. So for investments, in this case, we have 850 plus 50. 850 plus 50. So that is investments. 850 plus 50. 850 plus 50. But of course, now in this case, remember, kuna hii pesa walilipa wakinunua. So we eliminate it. We eliminate it from the investments. So that is an intercompany. It is an intercompany balance. So that is 300. In the note number 1, you can see the cost of purchase was actually 300 and 200. So we less it 300. We less the 200. Then there was also a loan that was actually acquired over 100. We'll have to less it from the investments because it is an intercompany balance. It is actually an intercompany balance there. So we have to remove it there. So we'll end up having to get an amount of 300. So take note of these ones. This is the loan they acquired. This is the amount they paid to acquire the associate. This is the amount they paid to acquire the subsidiary. We eliminate them from the investments because it is like money was moving this other side. So we'll end up having to eliminate it. So we'll get an amount of 300. Then you have, in this case, we have what? We have goodwill. So we have goodwill. So the goodwill we've actually been able to compute. The goodwill we have actually been able to compute in this case is actually totaling to an amount of I think 33. So I think we had actually computed it was coming to 33. 33. Yes, it is actually an accumulated depreciation of impairment of 33 because it is 25 plus 30 multiplied by 60. So in this case, it is actually goodwill is actually 25. Goodwill is actually 25 plus 30. So it is actually 25. Remember, the goodwill have actually been able to compute it incurred impairment. Since they acquired it as it had an accumulated impairment of 33. Tunakumbuka tuchukua 60% of that. You less the 33 in this case. So that is the impairment. You'll get an amount of 22. An amount of 22. Then in this case, we have investment in associates. Investment in associates to calculate. Investment in associates. Sasa, this is how now the associate is accounted for in the statement of financial position. You compute, kuna ile working tumefanya investment in associates. Sasa hapa ndio associate inaingililia kwa balance sheet. Tunaona hizi zingine tuna add tu za holding company na za subsidiary. Story ya associate hatutaki kusikia. Story yake tutakuja kuisikililia hapa. Tutakuja kuisikililia hapo. Story yake tutakuja kuisikililia hapo. So associate, this is how it is. This is now the equity method that we are talking about yesterday. You calculate this figure, then unakuja unaiplug hapa. So award vile tuna add hizi. Usianze kuadd ya associate. Associate is not consolidated. And this is now the equity method we were talking about. You compute this figure, then unakuja unairusha hapo kwa non-current assets. Unairusha hapo kwa non-current assets. Investment in assets, I think we got an amount of 230. Then we can look at now, in this case, the current assets. Current assets. Naona masani mbaya. Masani mbaya. It is mbili already. I hope there's no one going to class right now because I want us to finish this one. Inventory. We have inventory now. In this case, inventory is actually 200 plus 75. But remember, there was a what? Unrealized profit. Unakumbuka kwa workings. Nilikuwa nakuandikia tu vitu hapa na kuambia tu sasa ile tunafanya inventory closing stock tuta minus. Unakumbuka nikikwambia hivyo? So ndio hii sasa inakuja hapa. Si ndio hii unaona imekuja hapa unrealized profit ya 10. Hapa ndio imetokelezea sasa. Hapo ndio imetokelezea sasa. So in this case you'll get an amount of, is it 265 or something? Yes, 265. Then you have in this case trade receivables, trade and other receivables. Trade receivables. Trade receivables kuna in this case ya 300 plus 90. 300 plus 90. But remember kulikuwa na ile intercompany balance. Ambapo in this case walikuwa nasema trade payables za huyu zenye zimebaki hajalipa huyu mwingine ni 50. So unakumbuka nilikwambia uta eliminate na nikakuandikia hapo kando eliminate. So ndio hii tuna eliminate hapa sasa. So unaona tuna eliminate hapo sasa. So 340. So 340. So we are eliminating it now. Then in this case, we have financial assets at fair value. Financial assets at fair value. So easy una add to direct easy as in a story mingi. So 30 plus 20. So you get an amount of 50. Then in this case, we have cash and cash equivalents. Cash and cash equivalents. Cash and cash equivalents to Konapo, an amount of, in this case, how much? 150 plus 40, unapata 190. So I think those are the only assets we have. You can actually be able to add there. 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 Then in this case, tumalizie tu kabisa kabisa. Tumalizie tu kabisa kabisa. Before watu waende makwao. Before watu waende makwao. Before watu waende kujivinjari. Tumalizie tu kabisa. Before watu waende kujivinjari. Watu waende makwao, waende nyumbani kabisa. So now in this case, we have equity and liabilities. Equity and liabilities. We have equity and liabilities. Equity and liabilities. So tumalizie kabisa equity. Nakata equity and liabilities. 5 minutes, 5 minutes I'll be done. So ordinary, we have in this case ordinary share capital. So ordinary share capital. So ordinary share capital. Ordinary share capital in this case, we take the one that in this case is for the holding company. So if you look at now in this case, the balance sheet that we have up there. So unaona holding company ordinary share capital yake ni 1 million. 1 million. 1 million. Then in this case, we have share premium. So share premium also, you take the one for the holding company there. Up there, you can be able to see exactly how much. 300. Exactly 300. So the share premium is exactly 300. Share premium. Exactly how much? 300. Exactly 300. So those ones you don't have to adjust. So Gitonga unaona hizi. Sasa unaweza kosa kuweka hizi. So huwezi pata zero kwa hii kitu actually. Lazima kuna vitu. So zingine tuna add to direct. Azina kama hii na hii by the. Yani ni mambo rahisi tu, mambo mdogo. Hii haina story mingi. Una add to. So hii trade receivables unafaa uangalie tu kama kulikuwa na balances. Kwamba huyu alikuwa ameuzia huyu na hajalipa bado, uangalie kama ilikuwa. So unaona zingine una add kama hii my cash and cash equivalents una add to. So the marks are just direct. So you don't have to in this case start having to panic that you can score zero in this particular question. You must be able to score something. You must be able to score something. Then in this case, revaluation reserve. Revaluation reserve. Hiyo ilikuwa na mambo hapo. Hiyo ilikuwa na mambo hapo. In this case, we have for the holding company, which is actually 20, which is actually 200. 200 is actually 200. 200 plus. But now in this case, for these other ones, we have to take the post acquisition. We don't take the entire reserves. We take the post. Remember tumekuwa tukitumia huko kutengeneza goodwill. Sasa hapa reserves tunachukua za this particular point in time ya the subsidiary and the associate, tunachukua post after they acquired. How much was it? And therefore in this case you will take 80% of the post acquisition reserve. So it will likely be 50 minus 20. Then in this case plus 40%. In this case, the entire reserves is actually 50 that have actually been given. You minus, in this case, 25. So you'll likely be able to get a figure of 234. 200. So these are basically the post-acquisition reserves. You can note somewhere. These are how you get the post-acquisition reserves. So you take the current reserves, you minus the reserves that were there at the point of acquisition. And of course, hizo tumepewa, I think, note number 1. Ukiangalia note number 1 unaziona. Note number 1, I think unaziona. So ndio hizo hapo note number 1 unaziona hapo. Revaluation reserves at the point in time they were acquiring. Ndio hizi. Na hii. But in this one, the total reserves ambazo tuko nazo hapa, so unaziona hapo. in this case in the balance sheets tumepewa hapo, ndio hizo hapo unaziona. Reserves ni 50-50, so una minus, una get the posts, then you'll be able to get that figure. Then retained earnings we've computed. Retained earnings tumecompute na working hapo, ile working ilikuwa pale, hapo 922.4. Then in this case we have non-controlling interest ambao pia tumecompute, kuna working fulani imekuwa hapa, so it was an amount of 138.6. Then in this case we have the non-current liabilities. Non-current liabilities. So in this case, exactly 10% loan stock. 10% loan stock. So in this case, exactly 500 plus 200 minus 100. Remember this one we are eliminating. Kuna ile loan iko hapo kwa note number 1. Ninakwambia una eliminate hapo. Na hata nilikuwa nimekuandikia hapa kwa hiyo working, you eliminate. Nilikuwa nimekuandikia. Sasa hapa unaona sasa tumekuja ku-eliminate. So unaona tume-eliminate hapa. So 600. Then kuna current liabilities. Kuna current liabilities. Kuna trade and other payables. Trade and other payables. In this case, itakuwa 250 plus 250 minus this one. Remember ile intercompany balance iko hapo kwa trade receivables na trade payables. Huu mwingine ni trade payable, huu mwingine ni trade receivable, huu mwingine. We eliminate them. And of course, there is no cash in transit. Unakumbuka ile swali ya jana kulikuwa na cash in transit. Tukakuja tukai-eliminate, then of course in this case tukakuja tukai-add hapa. So and here we didn't less, hatukuless hapa hiyo intercompany balance. Because it was cash in transit that they had already paid. Ilikuwa kwa njia inakuja. But in this case, this one is not there. So we less also from what the trade payables, which is an amount of 50. And of course, you'll be able to get 450. Then in this case, we have the current tax. EPI ikuwa na mambo mingi. So in this case, 20 plus 20. In this case, you get 40. So I think it should be able to balance. So I think we can end there because I know some of you are going to another class. Some of you are going to another class. Others are going to start cooking ugali. Others are going to start cooking ugali. Others have already switched off. Others are going to sleep. So kila mtu anaenda kufanya mambo yake. So we can end there. So I think in the next class, I'm going to look at published. We'll relook at, again, in this case, published. We'll look again in this case at published. So you can be revising published because that is what I'm going to handle. But try to repractice what you've learned in this group because 100% it is going to be there. Maybe I think there is one thing that maybe I might have missed out. So I think I'll be able to maybe relook at... might end up having to relook at what. So there's group cash flow. But I think let's see what happens. So let's the group cash flow. But I think group cash flow you had actually covered a bit. You had covered a bit. So you're not actually badly off. I think you had already covered. So, but I would like to revisit published because all published will be there in the exam. Then also theory. Kuna ile nilikuwa nimetuma theory. Jaribu kuipitia sana. You can maximize on theory. It's averagely 30 marks. It's normally averagely 30 marks. You can maximize on theory. So kuna ile theory part nilikuwa nimetuma. Please go through it. Inaweza kuokolea jazi. Theory inaweza kuokolea jazi. Then group. Hii itakuwa kwa exam. Lazima itakuwa. So maybe what I need to look at is the group cash flow. Then I think, as I've said, next week, I think I'll also be able to look at published financial statements. published financial statements, maybe any other area that is of so much relevance, but don't ignore the other areas. Don't ignore the other areas. Still try to go through them. Try to go through them. Try to go through them. But of course, I'll be able to revisit published financial statements. Then I think we'll now in this case be in the home stretch. It will now be the home stretch. Otherwise, you can have a good night. So let's catch up sometime later.